Welcome to the deep dive. Today, our mission is to get you a shortcut past that single, that net income headline that everyone focuses on.
Yeah.
We really want to understand the complete financial story of a company. I mean, not just the profit number, but the hidden costs, the paper gains, and maybe most importantly, the motivations behind why management wants to hit certain numbers.
Exactly. And the income statement, it's not just a list of numbers. It's an economic story, and it's structured with a very specific set of rules. We're going to decode those final, more complex parts.
But what?
Well, everything from how R&D spending impacts the numbers to this idea of comprehensive income, all the way down to earnings per share. And then the really interesting part, the dramatic things that can happen when you tie millions of dollars in executive harassment paid directly to those numbers.
So the question you should keep in your head as we go through this is pretty simple.
Yeah.
When you see a company's profit, how much of that is sustainable, how much is real, and what incentives are driving the people who are actually reporting those figures? Let's start at the top. Revenue.
Revenue is the starting point, of course. But it's the composition of that revenue that tells you the real story about the business. You have to break down the streams.
Okay.
Take IBM. I mean, when you hear Big Blue, what do you picture?
Oh, massive servers, hardware, the physical tech, the machines that built modern computing.
Exactly. But if you actually dig into their 2012 revenue breakdown, the story is, well, it's completely different. Their biggest moneymakers weren't hardware at all.
Really?
Services brought in a gigantic $59.5 billion. Software was number 2 at about $25 billion. The hardware, their systems and technology division, that was less than 20% of their total revenue.
Wow.
So the insight for you is that the headline number, the total revenue, is almost meaningless until you know what's actually generating the cash.
That one fact just completely shifts how you see the whole company. Okay, so moving down from there, we subtract the cost of goods sold, COGS, to get to gross profit, and that's our first big measure of efficiency.
It is, but you have to know what COGS actually means for that company. For a manufacturer like, say, GM, COGS is the steel, the parts, the labor on the assembly line. But for a retailer like a Walmart, COGS is really just the wholesale price they paid for the stuff they're selling. The components are totally different.
Right. So after gross profit, we hit operating expenses. There's that big catch-all SG&A, selling, general, and administrative. But there are two other really strategic items in there that change how we should think about profitability: R&D and depreciation.
Let's start with R&D, research and development, because this is where accounting rules and long-term business strategy they clash. Under U.S. GAAP, every single dollar you spend on R&D has to be treated as an immediate expense.
Wait, hold on. If I'm a pharma company developing a new drug or a tech company building a new chip, that's clearly an investment in future income. Why can't I treat it like an asset on the balance sheet?
Because the accounting standards are, by nature, very conservative. They're worried a company might, spend $1 billion on research, come up with nothing, and still be carrying that billion-dollar asset on its books.
So to avoid that risk, they just said, expense it all now.
Expense it all now. Zero capitalization. Which means an innovative company is literally punished on its income statement today for investing in its own future.
That seems backwards.
That's a huge deal.
Yeah.
Look at a company like Intel or Microsoft. They'll spend something like 13 to 19% of their sales on R&D. They're intentionally reporting a much lower net income right now because they're spending billions on products that might not even launch for 5 years.
So as an analyst, you have to mentally add that back to see the real picture.
You have to. You have to adjust their reported income upwards to account for that strategic choice.
That's a huge takeaway. Okay, so related to that, we also have depreciation expense, which is just critical for understanding a company's actual cash situation.
Right, because depreciation is what we call a non-cash expense. It's just an accounting tool. You're spreading the cost of an asset, a factory, a truck, over its useful life. You pay the cash once, up front, but you record the expense in little pieces, year after year.
So no actual cash is leaving the bank account when that expense gets recorded. How does that affect the big picture?
Well, it creates this huge gap between the profit they report and the cash they actually generate. Let's go back to GM in 2012. They reported a net income of $6.1 billion.
Yeah.
Sounds good.
Yeah.
But their operating cash flow, the actual money the business made, was $10.6 billion.
That's a massive
A
difference.
$4.5 billion difference. And a huge chunk of that, about $6.2 billion, was that depreciation expense. It pushed net income down, but it wasn't a drain on their cash at all.
So for a big industrial company, operating cash flow is probably a much better health indicator than net income.
Absolutely. Cash flow is king, and depreciation is often the biggest single bridge between the accounting profit and the actual cash in the bank.
So once we get past all those operating costs, we have operating income. Then there are just two more required expenses before we hit that famous bottom line.
First is interest expense, the cost of debt. It's kept separate from operations because, taking on debt is a financing decision. The lenders get their slice of the pie first, no matter how well the business does.
And the second is income tax expense. This is where it gets a little murky, right? Because what they report isn't always what they paid.
Not at all. The income tax expense on this statement is the estimated tax based on their reported GAAP income. But companies basically keep three sets of books. One for shareholders, one for the IRS, and one for internal management.
And the tax rules are different from the accounting rules.
Very different. They let you depreciate assets faster, for instance. So the tax expense on the income statement is often very different from the cash taxes they actually paid to the government.
We've now worked our way down to income from continuing operations. The sources we looked at are really clear on this. This is the best number for forecasting the future. It cuts out all the noise.
We have to pause right there because this is a really important pivot in the statement. It's designed to show you what you can probably expect again next year. So anything that's a one-off, a non-recurring event, gets pushed down below the line.
And the first big category there is discontinued operations. Why is it so vital to pull that out separately?
It's all about clarity. It's a signal. If a company is selling or shutting down a whole division, investors don't want the losses from that failed business dragging down the results of the core business that's, still running.
Right.
The GM example is a classic. For years, they reported losses from their Hughes satellite systems business separately.
So that let you see that even if the total net income was low, the actual car business, the continuing part, was doing okay.
Exactly. It cleans up the analysis. Then you have something called extraordinary items. We have to mention them, but honestly, you almost never see them anymore. Because the rules are so strict. An event has to be both unusual in nature and infrequent in occurrence. So an uninsured factory getting destroyed by a volcano, yes, that's extraordinary. A big inventory write-down because your products are obsolete.
No, that happens.
That happens. That's just part of business. It stays in continuing operations.
And both of these below-the-line items, they're reported net of tax. Can you break that down? Why after tax?
Because a huge loss is more than just a loss. It's also a tax shield. Reporting it net of tax shows you the real final hit to the company. So if a division has a devastating $33 billion loss, that loss can be used to lower the whole company's tax bill, creating a tax benefit of, say, $12.2 billion. So the actual net impact, the real hit to shareholder equity, isn't $33 billion. It's $20.8 billion.
You see the true final damage.
Exactly.
Okay, that makes sense. So we've covered the continuing business, we've added back these one-time events, and we finally get to net income, the bottom line. But that's still not the complete picture of the change in a company's wealth. We need to talk about comprehensive income.
Right. This is where we capture the total economic shift, especially from things that are driven by market forces, stuff management can't really control. So the formula is simple. Comprehensive income equals net income plus something called other comprehensive income, or OCI.
And what is OCI?
Think of OCI as a kind of a holding tank.
Yeah.
It's for paper gains and losses that we don't want flooding into net income every quarter and making it super volatile.
So it's a smoothing mechanism. What kind of things go in there?
They're all market-driven and unrealized. The biggest one is usually foreign currency translation adjustments. If GM has a factory in Germany, its value is in euros. When they translate that back to US dollars for their reports, if the exchange rate moved.
There's a paper gain or loss?
A paper gain or loss. It goes straight to OCI. In 2012, GM took a $103 million loss just from currency swings that had nothing to do with selling fewer cars.
So you're separating currency market risk from, assembly line efficiency. What else is an OCI?
Second would be unrealized gains or losses on certain investments, what they call available for sale securities. If a company owns some stocks or bonds and their value goes up, that's not a gain from their core business.
So you don't want the stock market's daily swings making your manufacturing profits look better or worse.
Exactly. GM had a $45 million unrealized gain from this in 2012. It's a real economic gain,
right,
but it's parked in OCI until they actually sell the investment.
Okay. And the third big one involves hedging. like an airline trying to protect itself from rising fuel prices.
Yes, deferred gains or losses on derivatives.
Yeah.
If an airline uses a financial contract to lock in fuel prices, the value of that contract will fluctuate every single day.
Yeah.
Those gains and losses get deferred to OCI because you want the gain or loss from the hedge to hit the income statement at the exact same time as the thing it's hedging, the actual fuel purchase. OCI is the timing device that makes sure those two things match up perfectly. It keeps the core net income number clean and stable.
Okay, this all leads us to the final metric, maybe the most quoted number for any public company, earnings per share, or EPS. This is the translation from those giant corporate numbers into something that relates to a single share.
EPS is absolutely fundamental for investors. It's how you compare the profitability of one stock to another. We really focus on two types. First, there's basic EPS. It's a simple calculation. Net income available to common shareholders.
Which means you subtract out any dividends for preferred stock.
Right. You take that number and divide it by the average number of shares out there. For GM in 2012, their basic EPS was $3.10.
But then there's diluted EPS, and this is like the big warning sign for investors, right? It tells them what their slice of the pie could shrink to.
That's a great way to put it. Diluted EPS is the what-if scenario. It answers the question, what if every single outstanding stock option, warrant, and convertible bond were turned into common stock right now?
The number of shares goes up, so the earnings for each share must go down.
It naturally goes down. GM's diluted EPS was $2.92. That 18-cent difference from the basic number, that represents the dilution risk hanging over every current shareholder's head.
And this is the point where all this accounting theory stops being academic and starts driving real critical human behavior. We have to talk about income-based bonuses.
The theory, on paper, is beautiful. It's the good argument. You tie a manager's bonus, which could be millions of dollars, to a metric like net income or EPS. Now their financial interests are aligned with the shareholders. They want the number to go up.
But as the material shows us, that incentive can get really perverse really fast.
It creates this intense pressure cooker because net income depends on so many subjective estimates like how long will a machine last, how many customers won't pay their bills. Managers have a lot of room to nudge the numbers.
To manage earnings.
To manage earnings just enough to hit their bonus targets. They can pull revenue forward, they can push expenses out.
And that takes us from the good straight to the bad. The real-world consequences, and there's no better example than the waste management scandal.
Oh, that case is a textbook study of this. The executives at Waste Management were involved in, quote, massive financial fraud. And it wasn't just to make the company look good, it was specifically to hit the earnings targets that would trigger their performance bonuses.
So what was the actual fraud? How did they cook the books?
The main thing they did was they systematically extended the useful lives of their assets, their garbage trucks and equipment. So they were slowing down the depreciation expense.
And we just talked about how depreciation lowers net income.
Right. So by slowing it down, they artificially inflated net income. They also did things like inflate the salvage value, what a truck would supposedly be worth at the end of its life, which also lowers the annual depreciation hit. All of it was purely to falsify the earnings reports to make sure they got paid.
The pressure to hit that short-term number is just a massive conflict of interest. I know some companies have tried to move to better systems to counter that.
Yeah, you see concepts like EVA, economic value added. It's a much more sophisticated system that tries to adjust the standard GAAP net income for the true cost of all the capital the business uses. The goal is to shift the bonus away from something you can easily manipulate and toward actions that genuinely create more wealth for shareholders.
To better align long-term value with short-term pay.
That's the idea.
This has been a really insightful walk through the architecture of the income statement. It's clear you have to look for the tensions, right? The tension between cash flow and reported profit, between the sustainable business and all the one-time noise.
And at the end of the day, the income statement is a roadmap. It takes you from the predictable core business down to the total economic picture with comprehensive income, and then it translates all that into EPS for the investor. But that one tension we talked about earlier, that's the one you have to remember.
The R&D dilemma.
Yeah.
We established that R&D spending, which is absolutely vital for future growth, has to be expensed immediately, which lowers current net income.
Right. And we also know that a manager's annual bonus is very often tied directly to hitting that current net income target.
So the final thought for you to chew on is this.
Since spending more on R&D basically guarantees a smaller bonus for management this year, how often do you think genuinely innovative Important but expensive research projects get delayed or downsized, or maybe even cut entirely, just to make sure the executives hit their short-term financial targets. That conflict between long-term value and short-term pay is playing out in boardrooms every single day.